$70,000 to $81,000 into your Roth retirement plan, hidden in your 401k fine print. I'm Jeff Green, CPA at MedTax. If you're a physician in a group plan, two power tools can change your long-term picture. The Mega Backdoor Roth inside of your 401k and income-driven repayment optimization that lowers required student loan payments by shaping AGI. Used together, they're like upgrading from a basic starter kit to a pro toolbox. Same effort, smarter results. Let's start with the Mega Backdoor Roth. Many hospital and group 401k plans quietly allow after-tax employee contributions above your regular pre-tax or Roth deferral. If your plan also allows in-plan Roth conversions or in-service rollovers to a Roth IRA, you can stuff after-tax dollars in, then flip them into a Roth so future growth is tax-free. For 2025, here are the guardrails most physicians care about. The annual additions limit under Section 415C is $70,000. Your elective deferral limit under Section 402G is $23,500. If you're 50 or older, the standard catch-up is $7,500. If you're age 60 to 63 in 2025, there's an enhanced catch-up of $11,250. Catch-up contributions don't count towards the $70,000 annual additions limit, which is why all-in funding can land roughly $70,000 to $81,000 depending on age and plan features. The exact mix, pre-tax, Roth deferral, employer match, after-tax contributions, depends on your plan's document and payroll capabilities. Here's what to ask HR or your TPA. Do we allow after-tax employee contributions separate from Roth deferrals? Do we allow in-plan Roth conversions of after-tax money or in-service distributions to a Roth IRA? How often can I convert or distribute? Each paycheck, monthly, or quarterly? Does payroll support automatic sweeps so after-tax dollars move quickly to Roth? Coordination matters. Many physicians also have a 403B or a 457B plan from current or prior employers, and some groups sponsor cash balance plans. The big idea is to stay inside the limits and avoid non-discrimination issues while keeping W-2 reporting clean. Here's a tip. A separate governmental 457B plan usually has its own deferral limit, which can layer on top of your 401k or your 403B strategy when available. Here's a mini case study. Dr. Jackson earns attending level comp and has access to an after-tax 401k contributions plus in-plan Roth conversion. Payroll sets a fixed after-tax amount each pay period. Each month, the plan auto-converts the accumulated after-tax bucket to Roth 401k. The result? Significant Roth funding on top of the standard deferral without messy year-end scrambles. Quick pivot to student loans. Under IDR, or income-driven repayments, required payments are based on discretionary income. That's your AGI minus 225% of the poverty line for your family size under a SAVE plan when available. SAVE stands for Savings on a Valuable Education Plan. Lowering AGI with pre-tax 401k deferrals, HSA contributions, and in some practices, defined contribution / defined benefit stacking can reduce payments while you build wealth. For dual income households, modeling married filing joint versus married filing separate scenarios can sometimes help if your spouse isn't an MD with high income. But weigh the tax trade-offs before electing married filing separate status. Important 2025 note, portions of SAVE remain affected by court orders. Some borrowers have been placed in administrative forbearance and may not be accruing payment or forgiveness credit during that period, and interest has resumed for many. Always check studentaid.gov for the current status before you file or certify. Here's a rhythm that works. Map your year. Target pre-tax contributions early so AGI stays predictable. If your plan supports after-tax plus Roth, add the Mega Backdoor flow once your pre-tax targets are set. Reproject mid-year after bonuses or extra shifts, then adjust withholdings or estimates. If you're PSLF bound, meaning public service loan forgiveness bound, avoid late career moves that might spike your AGI in the final certification years. A few cautions: don't mix up Backdoor Roth IRA and Mega Backdoor Roth. There's different rules for both of those. Track basis and keep clean records of after-tax sources. Your statements should show after-tax versus earnings. With IDR/save, don't over-optimize payments at the expense of underfunding retirement. The sweet spot is keeping cash flow sane and building assets. For high earners, note that the Roth catch-up mandate is slated to apply after transition relief. Stay tuned and follow your plan's guidance. What if you switch employers? For Mega Backdoor Roth, know your exit strategy. Can you roll after-tax dollars plus earnings to a Roth IRA and pre-tax dollars to a traditional IRA or a new plan? Cue the paperwork before your last paycheck so nothing gets stuck. For IDR/save, recertify promptly once systems allow and update income if there's a material change, and keep copies of every submission. Quick recap, confirm your plans after tax plus conversion/in-service features, coordinate with other plans, automate the sweep to Roth, and use pre-tax moves to shape AGI under IDR. These two tools work beautifully together when payroll, HR, and your TPA are aligned. If you'd like a turnkey way to execute, I made a physician-friendly kit with email templates, a one-page payroll setup guide, and an AGI to payment calculator. Download the Physician Roth and Save Optimization Kit from the link below. Thanks for watching. If you're a busy healthcare professional who wants proactive tax planning, schedule a discovery call with MedTax today using the link in the description. I'm Jeff Green, and I'll see you at the next one.